In this video, guys, I'm looking at the pros and cons of using a moving average crossover strategy. Stay tuned. Hey traders, warm welcome to you. So unless you are a brand new trader, you are probably going to understand a moving average crossover strategy pretty much as a fast moving average, i.e. one that's on a lower setting, taking an average from a fewer number of days or a fewer number of candles if you're on an intraday chart. Crosses over a slow moving average, let's say crosses to the upside, slower being a longer number of days, so the average is smoothed out over a longer period of time. You're taking a signal generally in the direction of the trade. There are different ways you can do it. Potentially you can do it when the price is crossing. There's other different ways and different tweaks. So what I'm going to do now is I'm going to hit the screen. I'm going to talk about some of the pros and cons, because like everything in trading, there's no free lunch. There's always downsides to everything. So let's have a look at the screens and let's see exactly what the pros and cons are of using moving average strategy. All right, guys, so I've got in front of you here Euro JPY, and the settings I've got are, I've got a moving average here on a 50 period, a daily chart, by the way, and I have a 20 period. So there are multiple different ways of trading it, multiple different settings you can have, multiple different settings on your moving average, i.e. 10, 100 and 200 is a common one. Maybe got 10 and 50, but regardless of that, I just put it in here now. What I'll do is I'll make this a little bit thicker actually, because we just literally want to see the moving average on this. I wouldn't recommend doing this normally because you're just going to completely get rid of price. All right, so traditional moving average strategy, the first kind of upside, if you like, or pro to using it is it keeps you in good, strong trends. So it's a very good way of keeping you with a trend while it's continuing. So while you might get shaken out when you're trading under different strategies, you're not going to get shaken out over a moving average crossover strategy. For example, if you went short as the fast moving average here crossed over the slow and you're triggered here short, you are holding this all the way until it eventually crosses back over around about here. So you're getting a good, whatever that is, 600 pips move on this Euro JPY trade. So that's a nice trade to be in. And if you can catch those, that is the point of using the moving average crossover strategy. Similar here, as it starts to cross up, let's say you got in long here, you're in for 124, you're probably looking all the way up to around here to 133-ish. So again, a good chunk of move. Now, that's fine, and if that works, that's great. The problem, that's one of the pros. The other pro is that you can use it to keep you aligned with the current conditions. So if we use this scenario here now, this little condition here, while the price and the moving average is above the slow moving average, then you can say, I'm only going to position long. So you can use it as a filter. That's another good way of using moving average crossover strategy. You might also say, hey, I'm long, but I'm also only going to add to the position to the long side, and maybe I'm going to scalp it in and out around a core long position. So that's another pro. Now, the cons you've got with a moving average crossover strategy, guys, is number one, it can be so late to trigger you into a trade. If we go back, and by the way, you may think, oh, you're cherry picking stuff here. We can bring up any chart, we'll bring up another chart in a second, and just to kind of prove the point. And again, I'm not recommending or saying you shouldn't use it. Just be aware of the limitations of using a certain type of strategy. So for example, the danger you have is that very often by the time you get a trigger, you're quite late into the move. And example would be something like this. Now, yes, in this scenario, you're profitable. However, you've come a long way before you finally get the cross. The actual kind of move down here was from 146 all the way down to 140. So a 600 pip move really before you get the cross. Now, yes, in this instance, a very nice profitable trade. However, in some circumstances, and there was one we had up a second ago where by the time you get the cross, you're very late to the move. So here's an example here. If you're waiting for the pullback and cross, you're almost buying up the highs and you've got to sit with that for a long, long time before you finally get a move to the upside. Because by the very nature of the moving average crossover strategy, the moving average, let's move it to cable so we can see a kind of bit of variation. By the very nature of the moving average, guys, you're waiting. Let me clear off some of these other bits and pieces I've got on here. By the very nature of it, It's an average, so you're waiting and you're a little bit late to the move. Same here, you know, look at the cross here. By that time you get the trigger, it's very, very late to the move. So that is a disadvantage. So be aware of that. You know, you might want to say, okay, listen, if price has gone too far before I get the cross, then I'm not going to take the trade. You know, this is another good example here. You know, you're kind of pushing lower, and it's by the time that's triggered, you're probably selling into that spike by the time you've actually got the trade on there. So be mindful of that. I'm not saying don't use it, but just be mindful of it. The other thing that you've got to be careful of, and this is a great example of what it is working. You get the cross quite early on, and then you get the nice trend and eventually coming out of it. That's what you want from it. Now, the other thing you've got to be mindful of, guys, is the choppiness. So in cable here, GBP USD daily chart, if you're constantly trading in and out in a choppy environment, the moving average crossover strategy is going to rip your face off. You may be long here and you think great, then you're out and you're short here, and you're literally shorting at the lows, and then it's coming back up, and then you're covering here, covering almost at highs. You know, it's getting you in at the very worst possible time because it's lagged and because the conditions are, you know, they're very range bound in this environment. We're in a kind of bit of a channel. You know, things aren't as trending as they could be. Yes, they are. But again, you know, you're very choppy, you're making higher highs, but then you're reversing, maybe you're taking a low out. This is the worst kind of conditions for a moving average. Here's a great example as well. If you're buying a crossover here, you're long, then it comes down, you're short, you're taking out lows here, you're long here, you finally get a bit of traction, then it comes out here. It's very challenging to do that. So be mindful of the fact that you could get chopped up. So the pros we have are, number one, is it keeps you in trends. If you find a good trend in the moving average crossover strategy, it's great. It can keep you in the thing for months and months and months if you're a swing trader, and perfect to align yourself with that. Number two, it's good to use in conjunction, maybe if you're working around a core position. Let's say you're long and then you're adding only to the long side as you get little pullbacks. Great. The danger is you get chopped up in bad conditions because it's constantly crossing back and forth, back and forth. You're buying at highs, you're selling at lows, you're getting frustrated, you're losing. And even if you get on one of those trends, you might end up, you're not making the money back that you've lost. And the final thing is it's quite late. So it's quite late sometimes. Price might have ripped off to the upside. Finally, the moving average crosses over. You're very late to the move. Now, it's not to say that move isn't going to continue, but you've just got to be aware that that is very late in a move. And ideally, it will sit there and consolidate. Moving average will catch up to it and it will go another leg, and that's fine. But you've just got to be mindful if you're doing that, the risk you're taking when you're chasing that, the risk you're taking when you're buying right at that extended move, because it could still pull back and still be very, very bullish. You've got to sit there in a lot of drawdown before it goes again. So the answer to that possibly is that you say, okay, if it's moved a specific amount, I will take the crossover, but I will wait for a retracement before I get in. So I'll still use the weight of the moving average cross behind me, so to speak, but instead of chasing the thing, I will wait. Or you can stagger your orders and say, okay, I want to get in. This is part of my strategy. I believe this is the start of a new trend. I want to get on this trend. I'm prepared to sit through a bit of drawdown, but I'm going to perhaps scale into my position slowly, either as the price goes in my direction or comes away from my direction. Split my order up maybe a little bit each day, so I've got my full position size, and I can hold it over the days or over the weeks or over the months or whatever your holding time is. So moving average crossovers, guys, useful, but has their limitations, as with all trading strategies. Take care. Bye-bye.